over in Memphis, great weather. We've been having golf 70s, all week, all the past of November. It's unusually, that's unusual. It's usually a little in the 60s normally. So it's been nice. I've been hanging out, camping a little bit, hanging out with the family. Mark, how you doing today, man?
Good. Titans had a bad beat last night, so that was a little tough.
Right.
But, they're doing real well, so that's exciting.
Yeah, they did amazing last year. It was an amazing season for them. I went to one of their games. It was great. Always a good time. Well, all right, guys. So today we are talking about live. We're going to focus mainly on rent growth in Memphis, Tennessee, and also through other markets, how they've been faring with their rent through COVID specifically, and also then multifamily syndication, pros and cons to that. So, yeah. So why don't I first, we're going to reference an article. I'm going to share my screen here. Oh, sorry about that. Let me see which screen I need to share here. Screen that one.
And the article that we're referencing, if you would like the link, we're more than happy to send it your way as well.
Right. Yes, we would. Sorry about that. Let me see how this is messy. Okay, sorry about that, guys. I think I got it figured out. Okay, cool. Yeah. So let's reference this article. It is from Arbor Q3 2020 Single Family Rental Investment Trends Report. Okay, so diving on in here, they kind of talk about the state of the market since COVID and everything like that. On this page 4, so they've been talking about, they did a Census Bureau on occupancy rates across all single family rental properties, okay? So big data they're collecting here. And the average is 95.3% in Q3 of 2020, which is pretty freaking amazing considering the status and the state of everything. I think it's showing that, people who were renting through COVID didn't get kicked out of those single families. Why I think that? I think people were getting maybe more kicked out of the lower end housing, maybe not single families as much, because number one, they might have had more stable income and kind of not those transitory jobs like a waitress or something like that. They're earning more than that, so they want to stay in that single family. Also, because people renting in single families want to stay there because they're not in the big city, right? They're not packed. They're not densely packed. So I think single family occupancy has fared well compared to like some big 30-story skyrise in New York. That's probably going to have lower occupancy. So this one's for single families. Notice
right, exactly. And then what we're seeing now is there's a massive migration shift away from these downtown dense urban markets, and they're moving into the suburbs to rent a single family home because, hey, if you're going to be quote unquote quarantined, you might as well have a yard, have some more square footage. And we're also seeing a big shift from people being able to work at home. We don't expect that to last forever. We do expect people to start going, back to the office. But at the end of the day, right now, this is the major trend that we're seeing. We're seeing a big increase in demand for 4-bedroom rental properties because they want to use that 4th bedroom as a home office. Now, across the entire country, stating that there's a 95.3% occupancy in the third quarter, which is absolutely incredible for the single family rentals. Here at Reedy & Company, we're just over 96% occupied. So we're doing a little bit better than the national average, which we're really excited about. I mean, our leasing team is just absolutely just knocking it out of the park. They're actually running into a problem right now. They have a supply problem. They don't have enough houses to rent, which is a good thing.
Yep. Same with collections here at Reedy. We're doing well. We're faring well compared to other years, right on track or maybe a little better and maybe a little worse sometimes, but pretty well. Doing well in collections.
I want to give a big shout out to Logan Reynolds. We're doing fantastic. Happy Friday. Let us know if you have any questions. Happy to be of assistance.
Yes, Logan. How you guys doing? Logan, I'm doing well, man. How are you? Anyone else leave chats? Feel free to ask any questions or comments. We'll do our best to get them answered for you. Okay, so keep on diving in here. Going into page 13. It's a great article. We obviously can't cover everything in here. But the big one for us is this. So they're tracking future demand. I like that. They're tracking the proactiveness, looking straight up at the very beginning of that sales funnel for getting houses rented. Here they're tracking how many people are searching the Google search term homes for rent, right? And so and then they're stating maybe which market is Googling that the most would basically trend to show how the demand is. And of course, the reason why we're bringing up this article, of course, we want to mention Memphis. So
number one, woohoo!
Number one search term, Google search term of houses for rent. We can attest to that, seeing that with our boots on the ground leasing agents. We got 6 of them here. Obviously, we're buying 20, 30, 40 houses a month, so we got a lot of properties for rent always. And they're just saying it's crazy. They're getting flooded with applications, leads, showings, all of that. And yeah, we've seen a huge rent increase. I would say we're $25, $50 rent bumps on every lease renewal, and not getting too much pushback. And it even says that in here. Memphis led all major metro areas in August rent increases, growing 8.3% year over year. That first off, I mean, I'm like, is that even true? But I do believe it. We've definitely seen that. We're seeing a lot of restabilization of properties. I think we're seeing a lot of great jobs coming in. What else are you thinking, Mark?
Yeah, what's also great is that is including, and for us, we're putting everyone on 2-year leases. That was a big swap that we made this year. We started that January 1 of 2020, because up until then, we were always on 12-month, 13-month leases. And then now we're putting in a 4% rental increase that's baked into the lease between year 1 and year 2. And the way they're explaining that to the potential tenants is, hey, look, the market rents could go up more than 4%, or it could go up below 4%, right? We don't really know what the future is going to hold. So at least you know what to expect and what to budget for that second year. And then what's even better is you guys as investors, we can actually put that into the pro formas, and then we know what the income should be for that second year. So it helps predict your future cash flow.
Love it. So just mentioning other cities here, we got Augusta, Georgia, Macon, Georgia, Columbia, South Carolina, Dothan, Alabama, Florence, Meyer Beach, South Carolina, Albany, Georgia. So Georgia, yeah, definitely Georgia's seen a big increase as well. I'd be interested to see what other people in Georgia have to say about that and their feelings on rent in Georgia. But, I think just people moving to the Mid-South, right? Just a general trend. They're moving. We showed that last week in our live. Go back and check that out. But just the California and big East and West Coast cities, New York's and Boston's and all of them, they're seeing rent decreases and thus probably lower occupancies. And all these cities like us in the Mid-South, kind of more affordable houses, more spread out.
Lower taxes.
And also you can work from home, live wherever. We're seeing an increase in rents. Memphis had one of the best rent increases through COVID, and actually had a rent increase through COVID, where most markets were down a few percentage. And San Francisco was down like 20%. Wow.
That's correct. It was just over 19%. They were the number one. They had the hardest hit basically from COVID, which I couldn't imagine. Your rent goes down 20%. That's got to be tough.
Yeah.
And that's kind of the joy of Memphis is, we are much more linear of a market. As opposed to much more cyclical like the San Franciscos of the world. And even the same thing happened in 2008. Other markets, their rents decreased. Well, here in Memphis, we were able to release all of our properties for the same rents and continue increasing them, which as a single family rental investor, that's probably one of the biggest risks you have is, what if your tenant leaves and all of a sudden you can't find a new tenant for that same rental rate? So now you've got to drop it 20, 30%. And there's a lot of reasons why, that could happen. But it didn't happen in 2008 for Memphis, didn't happen during COVID. And it's one of the great reasons why we invest here.
Yeah, going off on that, I talked to a guy from the Las Vegas market during the crash. It was like overnight house prices dropped. He was saying it dramatically, of course, but he's like, it was a couple months, like definitely a year. That market dropped quick because Vegas is a very, very volatile market, and the California markets. Where Memphis, we're not appreciating a crazy amount every year, but we're getting up there. But we're out. Then like you mentioned, kind of buffers it out. We don't depreciate a crazy amount. We kind of lag behind the other markets, which is nice for our market because we just look at how other markets are doing typically, for the most part, and kind of see the future there.
Yeah, and then another market that got hit really hard in 2008 was the Florida market, just because it was a supply problem. Down there, they were building thousands and thousands of houses from the new construction ground up model, selling them to homeowners. And then when 2008 came and those individual buyers had a credit problem, they couldn't buy the home, they couldn't qualify for the mortgage anymore. So now they could no longer buy the home. So what does the builder do? Well, they're not just going to go bankrupt. So they just flood the rental market. Right. So now, as a local investor in Florida, those individuals, when their tenants would move out, or when the lease came due, the tenants wouldn't renew. They would just move to across town to a brand new, bigger, new construction house for the same rent. And so now the current mom and pop investor had to lower their rent drastically. And that's where some people that don't have enough liquidity can kind of run into problems. And then bringing that to Memphis, we were doing about 4,000 new construction houses year over year up until 2008. And since then, we've been doing about 1,000 houses year over year. And that's continuing to this day. So we actually have an undersupply problem, especially because the majority of those new construction houses, they're coming in at around 300, 350,000. So this market where the homes are of existing homes under 350K, it's growing. It's doing well.
Awesome. Yeah, Logan Reynolds, cool. So he actually used to do some of our HVAC renovations on our properties through another company. And then he's asking, how's the Little Rock market going? So Little Rock is literally just a 3-4 hour drive from Memphis. I've been there a couple times, kind of fun, Hot Springs, Arkansas. Yeah, it's very similar to Memphis. I would say faring pretty much the exact same. I mean, I looked at houses over there. They're just face to face, almost the same as ours. Maybe a little bit lower priced, a little bit not quite as much of economic development going on in there, like the big major employers we have here in Memphis. But yeah, it's a fairly decent market. So that's how they're doing. Great question. Okay, so let me share my screen now again here. Mark, oh yeah, so yeah, let me go up here to this third. So yeah, going off this 8.3 year over year rent. Now, I don't think this is going to happen every year, but for the sake of being, just having a good old time playing around with some numbers here. So I created kind of these are just several of our typical houses, right now, 900 rent, we're selling them for 100,000, 3-bedroom, 2-bath, a carport on there and everything like that, 1,250 square feet, 1980, 1950s, even 1990s build. It's our typical house. So with that, I basically put our pro forma on here, just not quite as pretty, but they're going to cash flow around $238 a month, have around a 12.48 cash on cash return. You're going to have some maintenance, $648 a year, 4% vacancy is what we put on all of our pro formas, insurance, taxes. We have estimated on here a 4% interest rate, 30-year AM, 20% down with some closing costs and all that. So yeah, that's where we're getting these numbers from. So here's what's awesome. So I'm going to say this is year one. Okay, so you kind of see what we're doing here. And Mark, chime in as you want. And then year 2, 3, and 4. So let's say just year one, you buy a rental in Memphis, like let's say this year, the beginning of this year, and rent was $900, right? Now let's assume this Ann Arbor article that it just keeps going 8.3 every year. I don't think it will. I think it'll be more around 4 to 5. That's more what it's typically been, but let's just do it for a fun case scenario here. So we're going to do the 8.3 increase times our 900, and we're going to have to make that 1.83. So that'll be a $75 rent bump, which is huge, and we're seeing that in some areas. So equals our 75 plus from the 900, so that's going to be 975. So look at that. So what happens here, let me just manually put that in, is our cash on cash return goes from 12.48 to 15.72. And our monthly cash flow goes from 238 to 300. Reason being, what we have is, all we have in here is, the only expenses that really increase is, thinking out loud here, Mark, is our management fee.
The 8% management fee.
So instead of 8% of 900, you're charged 8% of 975. And then we do have the maintenance is based on the rent. So, because as rent increases, maintenance will increase theoretically from there. And we have a maintenance of 6% of the gross monthly rent. So that's what's happened. So yeah, I mean, it is factoring in for also expenses increase on here, is what I'm saying. So look at that. Now we have $300 a month cash flow. Okay, now you're like, all right, that's pretty freaking awesome. I mean, you just increased your return. Let's look at that difference. 15 to 3.24. So from what you originally thought to that, that's a 26% increase on your return. And you're just sitting there doing nothing. And I love what Aaron Chapman says about this, is like, he goes out the lender can't come to you and be like, oh, well, because you're getting more rent, you owe me now, half of that more on my mortgage. No, your mortgage is fixed.
Mm-hmm. Yeah, mortgage is fixed, and that's the same thing with appreciation. As the value goes up, the cost of your mortgage doesn't increase with that as well. You get to keep that yourself, and that's what the equity comes from. But then you're correct, Sean. Statistically speaking, the rent growth in Memphis has been just over 4% year over year. So obviously the 8%, that's a little bit of a big jump that we're coming in from this extra demand from COVID. So, you can continue to the next year and have it go up 4% after that one, after year 3.
Right. So I'm going to do this in both scenarios for you. So I'll do it with the 0.83. Okay. And then I will do it with the other one. You can
see you, Logan. Have a great Friday. Appreciate you.
Yeah. Have a good one, buddy. Thank you. So we'll do this for the couple 5 years here. 1, 2, 3, 4, 5. So there's for the 5 years. You're just having a slight, that 0.83. Okay. Now let's do it with the other way where we're having a 4% rent bump, kind of more what we're thinking here and kind of estimate. So each year over year. So that's what you would see there. All right. So let's bump it over this way. Okay. So look at that. If we do the 8.3, it's just kind of fun to see. You're going from a 12% return from your initial, then that 5th year, you're seeing a 27% return. What also haven't factored in here is your 5th year, your principal pay down is more, which is not factored in here on that 5th year. So anyways, it's probably
it gets even better is what you're saying.
Yes. And your cash flow is going from $230 a month to $516. Okay, now obviously let's just do more of a conservative. So 12 to 19%. And your rent goes from $900 to $1,050. Cash flow from $238 to $364. I don't know, man. I love real estate so much. I do this all day long. I just analyze, look at these theoretical scenarios. I love looking at my trending past data, what actually happened for my projections. It's just so awesome how there's a lot in your favor to go well. What this price is going to go up over time. Theoretically, hopefully, and it has for me.
Right, with the limited supply that there is in this space.
Right, just approaching it from that long. I just think long term, you're not going to go wrong. You're going to have so many things that can go well your way, and especially you can just ride it out even through another downturn.
Right, and it's all about being on the right side of trends, and that's what we really like just about the rental market in general. Is that back in 50 years ago, it was the American dream to own a home. But now it's more of a dream to be financially independent, to be more mobile, to be able to go travel the world, be able to pick up and move. And that's why there is this increase in demand for rentals just across the board, just nationwide.
Right. Mark, I love it. Okay. So of course this is like my total, I love it. Like being free. I want the opportunity to go travel the world for 3 months and come back with my bank account having more money in it. So let's say it costs you 10 grand a month to travel the world. Okay, right? So you need 10,000 a month. How many rental doors do we need? And now let's say we bought it just day one. We need 42. But, as seen here through these theoretical models, let's say we're already in year 5 with a bunch of them, right? Divided by just the cash flow from year 5. Ooh, that's not right. Divided by, because I had 100,000. 27. So, you need 27, 25 to 40 doors, and you can go be living that lifestyle of whatever it is and have financial freedom.
That's a fair chunk of change. 10,000 passive income per month. That's incredible.
Right. I can live off much less than that.
Yeah.
That's a pretty lavish lifestyle, I would say, especially not working and you're just collecting this cash flow.
Exactly. So back to the actual trend reports on page 15, we'll send this your way as well. It just kind of has an outlook for the entire single family rental sector. And it states that the single family rental sector may be the best positioned residential asset class to see continued growth through the end of the pandemic. SFR's favorable counter-cyclical profile has combined with the confluence of demographic and migration factors, boosting tenant demand and retention.
Mhm.
While living rooms and pajamas are unlikely to replace conference rooms and iron shirts permanently, the growing acceptance of remote working should continue to elevate demand in urban adjacent suburbs, all else equal. Landlords are not entirely out of the rent collection woods just yet. The COVID-19 recession is proving to be more of a marathon than a sprint, and accommodative policies are waning. So, wow, that's exactly what we want from a long-term investment, something that's counter-cyclical, something that's not tied directly to the stock market, is exactly where we want to put our funds, and we can control a little bit more and is on the right side of trends.
I love it, Mark. Dude, counter cyclical indeed, especially through this COVID. And that's what kind of we're saying at the beginning. Also attesting to that, it is counter inflation in a way. What I mean by that, I mean, if there's inflation, right, home prices are going to go up, right? But what
Right.
happens is you're locking in a 30-year mortgage at today's dollar value, where we
Right.
know the dollar
Fixed.
value is going to get valued over time. So, I mean, and as inflation goes up, and if we think inflation is going to increase, like the percent of inflation and the rapidness of how things turn over in inflation more, real estate's going to be the number one thing that's going to benefit the most, especially if you're leveraging it with debt.
Yep. That's why they call it a hedge against inflation.
Right. I love it.
All right, so we can talk about some other hedges against inflation. We've got the single family side. We also have apartment syndications as well.
All
So
right.
that's kind of one of the big questions. People think about it all day, every day is, what is the difference and what are the pros and cons? And should I invest in an apartment syndication or a single family turnkey rental? And of course, there is no right or wrong answer. The answer is just depends on.
Okay. I'll take the single family and you take the multifamily. Is that all right?
Okay, perfect. Go with the single family.
Here's why you should invest in single family. You've seen it on my thing right here, guys. I mean, you're getting the rent bumps. You're getting that multifamily too. I feel like, if something's going to appreciate in terms of rent bumps quicker, I mean, after that, multifamily will increase a lot too. But I feel single family, will always keep going up in rent bumps. The limiting, I don't know, I'm not proving the case, but the limiting thing might be rent caps. There is only so much someone can afford, where multifamily is typically priced less. So that could be on the multifamily side. But with that, then that means people are going to be buying them as homeowners. And I think single family is going to appreciate more because you're selling it to someone based off their emotions, based off what the carpet looks like, based off, I'm going to have my family live here. They're not going to buy it based on a cap rate and how much is this worth and what's my ROI. So you have two exit strategies. You can sell to an investor and you can sell to a homeowner. Where multifamily, no one's going to buy a 100-unit apartment complex thinking, I'm going to buy this just to live in one of the units, right? Or bust out four and make a mansion.
Right, because you just listed a single family home for one of your friends, and one of the offers was, hey, I'll pay 10 grand over appraisal.
Just because I want it, I like it because there's a dog park. There's a park right in the back that you can just open your fence from. It's like, I just like it because I can put my dog there. And because of that, I don't want to miss out. I'll pay 10 grand more than what it even would reasonably appraise for. And the supply and demand, the craze.
Right. Single family, you've also got more control over the investment because with that, you are the CEO. It is your business that you're actually creating. So ultimately, at the end of the day, since you have more control, it's really nice. What if you want to fire your property manager? You can do that. What if you want to sell the property tomorrow? Or what if you want to hold on to it for 30 years? That is your decision. And that's a big pro. Control is huge.
A con is, though, with single family, it's leveraged in your name. You're typically getting these Fannie Freddie loans. You are personally guaranteeing that, so they can not only go after the residents, but other assets that you have if you do not keep up to those terms on the loan.
Right. The majority of single family investors are going to be using a conventional mortgage, which is called recourse, which means if something goes wrong with that debt, they're going to come after you or us personally, as the owner and the investor of that. It also shows up on your debt to income and your credit score, or credit report as well, which some people really don't want,
Yes.
More exposure for sure.
But kind of have some also other exit strategies and options. With a single family, you can Airbnb it sometimes, get maybe a little more rent if you want to put more work into it. Obviously, like I said, you can sell to more people. You can, it's just one asset, pretty simple to work on.
You get to keep all of the returns, obviously minus the expenses. You don't have to split it with someone else, with a partner. So it is all yours, which is huge.
Going on that, the barrier of entry, it's high, but it's definitely lower than buying $1 million, $10 million apartment complex. So the average American can afford a 20 grand. Well, not the average, but our people listening, our people who are on average, but awesome investors can definitely afford a 20 grand down payment. Where most of our investors, $1 million down payment can't really get to that. So barrier of entry, a little easier.
And what we've seen as well is with the appreciation in the marketplace. I mean, we've done the math on our last week live, but just a 5% appreciation year over year, which is what Memphis has had consistently since 2016, an annualized 5% appreciation. If you put 20% down and finance that, we're talking about a 20% plus ROI just in equity appreciation alone, not including cash flow, not including the tenant paying down your mortgage. So normally what we find is that the total ROI for the single family homes is going to be greater. But you also have to, basically put that debt into your own name. And it does take more time. Actually qualifying for a mortgage is not the easiest thing in the entire world. Especially if you're self-employed right now. They made it really tough.
Yes, I just bought a house. I'm self-employed. Oh man, they asked for everything, besides a
blood
exam and blood samples. Pretty much just shy of that. I wouldn't be surprised if they asked for those results.
Yeah. Well, we had one investor who had to give 101 documents because she was self-employed. It's one of the negatives of COVID is that they've made the restrictions much more difficult to be self-employed. Now, if you're a W-2 employee and you have a good DTI, good credit score, good income, but you're good to go. It's very easy. But being self-employed like we are, it's very tough. And that kind of is a nice segue into the benefits of apartment syndications is if you have any issues with your credit, and you're not bankable, let's just say you don't live in the United States of America and you can't even qualify for a conventional loan, that's the big benefit of apartment syndications. Some of our biggest investors are in Australia, right? And so you really, at the end of the day, for a syndication, once you trust the market, the asset, you've read the 50 to 100 pages of legal documents, really from there, you sign your name, wire the money, and your day-to-day operational responsibilities from a high-level perspective are pretty much done. You really just sit back and let the team that you hired to make sure that it produces a good profit.
Right. Let me go off on the tax advantages. So single family, you get great tax advantage, right? You can write off, depreciate the property 1/27 and a half over time, and talk to your CPA and accountant. We're not accountants, but talk to them about that. You can write off a lot of the business travel expenses for going over there and all that. It's now become a mini business for you. And, you can also write off any of the expenses for paying for the property manager and repairs, some of the repairs and things like that. What you really don't get to take advantage too much in the single family is a cost segregation study, where you can break down the property into different lifespans of the assets in there and have accelerated depreciation on some of those assets or bonus depreciation.
Right. You can use a cost segregation study on a single family home, but you got to get with your CPA to see if it's worth it. It's worth the cost.
Because it's usually you need at least $250 or $500 purchase price for it to be kind of worth it to pay for the study to get the advantages of a good ROI on it. Where multifamily, I mean, you're buying it for $1 million, $10 million, you're definitely going to want to get a cost segregation, or if you're doing a big heavy reno on the property, you can write off all of that.
Yeah, using the bonus depreciation. Yep.
Correct, which helps you even more with that.
Yeah, so then going into pros and cons of apartment syndications, I would say another one of the cons is that it's not liquid. You're locked in for the duration of the investment, and it's up to the sponsor to execute the business plan. And normally inside that business plan, they're going to state, we want to hold on to it for 3, 5, 10 years. But let's say they say in the business plan, they're going to sell at year 7, but these strategies are more of a buy and watch, right? You buy it, you renovate it, increase the value, and then you just watch to see what the economy and the market and cap rates are doing. And if things are poor at year 7, even though you put it in the business plan that was your goal to sell, you're probably going to want to hold on to it for a couple years longer. And for some investors, right, you want to be more liquid. You want to be able to, if you do want to get out of the investment, it's much more difficult. It's not impossible to get out of an apartment syndication. It's just much more difficult.
Right. Also, I don't know if you mentioned, but then you're also splitting fee. You're probably going to pay fees to the manager, someone running it, because they're doing all that legwork to pool together people's money, get everything done. There's different fees and splits. We won't go into that, but that's something depending on the property and all that and the syndicators. That's other things to look into.
Mm-hmm.
Did we mention you don't have the loan in your name?
Nope, not yet.
So yeah, what typically happens, well, I mean, actually 100% of the time typically is the people putting the money in, they're passive. And so they're not on the loan on signing any of those documents. And also typically most of those loans are non-recourse loans because they're just so big anyways. It's just based on the recourse is only the property. And then, unless other things, they have all those stipulations in the loan docs. But yeah, so that's a pro on it. You get also better availability of like larger financing because it's a more trusted asset. Looking at the stats, actually, through the crash, one of the asset classes that had the least foreclosures, the ratio, was multifamily. And then I think commercial, then single family was kind of more up at the top in real estate terms of foreclosures. And that makes sense because we're not buying based off emotion. So when we do buy it, we're looking for a return on investment and investors aren't going to foreclose. Also, we're putting a lot more down, right? We're putting 20%, 25, 30% down. We have a lot more skin in the game on this big multi-million-dollar apartment complex. Economies of scale, you can write it out. Where single family, even a single family investor, they're putting, especially a homeowner is putting way less down. They might put nothing down or 5% down.
Right.
We're willing to walk away from that. And also they're buying based off emotion where they probably shouldn't have bought it anyways, especially.
Right. Plus in 2008, they were buying their second beach home, third beach home, yes, low to no money down. And they were a waiter. That's ridiculous.
Yeah. And their underwriting was, can you breathe? And you have a pulse? Oh, okay.
Yeah. Great. Yeah. Thank goodness the underwriting is a little bit more strict now on that side. But one of the other benefits of apartments as well is you're going to own a small percentage, a little bit of a larger pie. Right. And so since you have multiple doors, like what if you just have one bad tenant and you have one single family home, well, now you're 100% vacant, now you're actually losing money every single month. Well, on the multifamily side, you got 100, 200 units. So if you have 1 or 2 or 5 bad tenants, well, that's okay. Proper owners are going to underwrite knowing that there's going to be X% of bad debt, or essentially individuals, tenants that aren't going to be able to pay, evictions. It's all planned. So it's to be expected. And because of that, it's considered to be, less risky, more diversified. Now, that kind of argues, what if you had 100 single family homes and 100 unit apartment building? Well, that's a whole nother story.
Right. I still think though, the pro of multifamily there is, drive time. 100 single family homes, you're probably going to have a 30 minute radius, maybe an hour. I mean, driving each one of those take forever. We're multifamily, knock each door, collect that. We're typically seeing a little bit better collection rate in Memphis, Tennessee on multifamily than in single family out of what we manage. And it's because it's easier to collect. You can go face to face with them all within the same day of everyone who's late on the 6th or the 5th of the month.
Right. And because the actual tenant has to walk past the on-site property manager to get to their unit every single day. So that's what's great about having an awesome on-site manager, is that they're going to get to become friends and they're going to get to know everyone in the building. And it's much easier to just say hello and ask for rent.
Right. Economies of scale. It's all under one roof. You might have one roof covering 16 to 30 doors. Now it's going to cost not the same as one roof because it's a very larger roof, but it might be half the cost proportionally to 16 single family doors, which I think is awesome.
Exactly. Then there's also the initial investment. Normally you can get into a single family home for a little bit less, but once again, on the apartment syndication side, I was talking to one friend and their minimum investment was $200 million. That's just a whole nother world. It just depends on the individual sponsor. You can figure that out. You can do a crowdfunding type of thing where you can invest just a couple $1,000s, or you could go up to some of the biggest funds in the world and you invest hundreds of millions.
Right. So yeah, I'm trying to think cons. There's pros and cons to each side of it. Just looks at how you want it. Cons are you don't have control, and if that's what you like to do, if you like to get down and dirty and you like to renovate it yourself, you might actually get some better sweat equity buying a single family, managing it and renting it out yourself. And that actually is a huge increase in value. You're usually paying 5 to 10% management fee. You can control that all over on a single family. So you kind of can add your own little pizzazz to it, and you can do the renovations yourself and pay half the cost, just pay for the materials. So there's that. Also, when you're selling it, single family, to sell it, you get more exits, where multifamily, you're selling to an investor, which is based off the market cap rates and what other investors will pay, and they're looking for a good return. So they're not typically way overpay.
So either way, we invest in both. We love them both. It really depends on, I think it's more so of a control thing. If you really want the control, go single family. If you want it to just be passive and just say, hey, I'm hands off, I just want my mailbox money every single month or quarter, whatever the distributions are, that's better for apartment syndications. And as well, with just the amount of real estate in general, really comes down to the financing options that you have. The benefit of single family home is that you have those conventional mortgages, which are incredible loans because they're 30 years fixed, 30-year amortized at very low interest rates. Well, once you've utilized all of those 10 conventional loans, because each investor with an income gets 10 conventional loans, then the question is, what's the next best strategy, right? What should I do? And a lot of our investors, that's their goal. Get 10 single family homes to maximize their conventional loans and then swap over to the apartment syndication world. Just another one of the many strategies.
Yeah. Lastly, I think not mentioned, you may need to be an accredited investor, meaning have $200,000 in income for the past 2 years, or $300,000 if you're filing jointly, or $1 million net worth, excluding your personal residence. To join in that syndication typically.
Yep. So you got to check with the sponsor on that one, because sometimes you can be accredited, sometimes you don't have to be. So you just have to check.
Yes. All right, man. Well, I think that pretty much wraps it up for us, guys. Appreciate you guys checking us out. Leave your comments down below. We're happy to have you watching us, and yeah.
All right. Well, guys, we're signing off. Happy Friday. Have a great weekend, and see you in a week.
Bye-bye.